Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. March Corn Futures is giving us much of what we had been looking for. After having moved up to resistance at the 360 price level, the market has since been declining and is now moving down right into our mid-month time projection. As we can see, the market continues to move down, and we have two areas of potential support where the market can hit. Either somewhere in the neighborhood of 347, 348 for potential support, or the market could break that level and then we'd be looking at somewhere near 340. Either one of these price objectives could very well become a very good support for this market now that we have broken previous lows. A nice run to the downside that coincides with our mid-month projection does look very nice. We are starting to approach the Christmas season, so we would not be surprised to start seeing some slowness in volatility and for the price action to really narrow. Going forward, we simply would be looking for some key support levels for the market to bounce from for an opportunity for a nice move to the upside. The small bounce / support that we're seeing right now does happen to coincide with our 360-degree mark at 347.5. And also we can see from the market here that our volatility bands have started to make a shift to the upside, suggesting that potential support near this 347 number could very well hold. Again, the next level that we'd be looking for is that 340, which would be where our next volatility bands rest. So for now, those key levels are going to be important. Beyond the December 15 timeline, we do have our next timeline coming in on Tuesday on the 19th. So anytime during the end of this week or even potentially early next week as we move into Christmas could very well be a very nice timeline for potential reversal in this downtrend. The May contract is moving in a similar fashion where it found resistance about 2 weeks ago. It has since now moved down where we have support potentially near 356. And in the event that this 356 number does not hold, we would then be looking somewhere in the neighborhood of about 348 for a potential downside target for support. The end of our blue timing region does land on December 22nd, which suggests that the market can continue to move slightly down to sideways going into the Christmas timeline before a potential move to the upside. In any case, we continue to like sometime at the end of this week or early next week as a potential reversal point. If that doesn't hit, we're looking at a move going into the Christmas holiday, and then from there look for a move to the upside. The January beans contract was not able to get beyond our 1013 resistance level, and upon hitting that area over the last 6 to 7 trading days, the market has been straight down from there with the small inside day bounce that we're looking at today. Since it was not able to get through the 1013 number, it was not able to get to the 1031, 1032 number that we were looking at overhead, and instead the market has made its way back down and has broken that initial 984 number that we talked about. Now that we have cleared that 984 number, it is very possible that this market can continue down back to that initial target of about 960 that we had previously discussed. And once again, we're looking at about December 22nd as a potential timeline for this downdraft to finally find pause. Looking at volatility-based support, we can suppose that that 960 to 965 number is a very good target potentially for this market. And in the event that we do reach that area, we can find some support coming in that number. And depending on the way in which the market reacts to that 960 number, we could potentially see even further movement to the downside. So holding that 960 number is going to be very important for the beans contract. The July beans contract is moving in a similar fashion. It reached very key resistance overhead at 1 standard deviation above the point of control at 1044. And this is where the market collapsed. And that level actually happened to coincide with our 2x1 upside angle right overhead. The 1x1 angle did not hold, and when this happens, the market will often make a move at a minimum to the downside 1x2 angle below. That angle below sits right at our point of control at 1,950. And as we can see here, the market is giving us a small bounce right upside, right in that level here. In the event that this area is not able to hold, we anticipate that the next leg down could potentially go down to about 975, and that 975 to 980 number is going to end up being for us what we consider a line in the sand level. We've elected to show some arcs and how they've actually operated with this market coming off of a scaled swing, and we can see where the market, each time it hit this arc, was able to produce a very nice reaction. These last two times in particular showed us some very good lows, especially when it coincided with the potential support or resistance level. Here we have our next arc coming in. So in the event that this market declines to about 995, and if it's able to hit the arc at the same time, we stand to believe that a potential move to the upside from this time horizon is probable. This chart shows us where volatility-based support lives. And that 980 number that we spoke about before was derived using some key elements with the market here. So in the event that the market again is able to break through this area here where we have our point of control, the next area down then would potentially be near that 995 number, which is the top end of where volatility-based support lives. So we have several pieces of confluence coming together for that 995 number. And again, our line in the sand is at 980. At which point, if the time factor works out well, we're looking for the market to potentially move up from that 990 to 995 number. Global inventories continue to weigh down on the wheat complex, although our divergence continues to persist. As we see the market making new lows, the momentum of those new lows continue to shrink. We do have our potential downside target coming in close to that mark that we discussed before. And right now the market's finding a bit of support very close to 409, 410, which happens to be 2 standard deviations below the point of control. We have a timeline coming in for this market at the end of this week, close to the beginning of next week. And so we would wait to see the way in which the market responds. But what we're noticing here is the potential of time and price coming together, which would indicate the potential for the market to make a move back up. Confirmation would be upon breaking back above 424. If and when this market's able to find some strength back above 424, after reaching this time and price threshold, we think that this would be good confirmation for the markets to begin making its way back up again, at least for the short term. If you recall previously, that 424 number was an important level for us as it coincided with the 360-degree mark. Upon breaking here, the market moved all the way down to volatility-based support, and now we find a bit of a bounce coming in, and that bounce could last for the next 3 to 5 trading days. If that holds again and the market breaks back above that 424, which actually happens to coincide with one of our natural sinusoidal trend lines, we think that the market could find some legs, and at the very least, look to test that 445 number overhead. In closing, we'll have a look at the US dollar. Once again, we like very much the way the market traced down our natural arc coming in, found support up against our volatility-based support area, and from here we did anticipate that the market could move sideways 5 to 7 trading days, and then potentially have an up leg to it. We did believe that the market could very well find very good resistance at the 180-degree mark near 94. That's exactly what we're seeing today. In fact, the market made its way up just past 94 to about 94.15, where our Fibonacci number did rest in terms of a retracement of that previous leg. And now we see a very nice down day from here. In the event that this market's able to break below 93.42 by the end of the week, we anticipate that the market would make its way back down, leading us to believe that our initial projections for our weekly chart could very well come to fruition. On our weekly chart, we did have wave A or 1 coming in at this particular low, with a B leg coming in just above. Now, mind you, the market can continue to make its way up since it never really reached all the way up to this price objective area. So one of two things can occur right now. Either we're looking at a small ABC correction inside of the leg where the market can make its way back down to about the $90 mark, or the market is in the midst of a small ABC leg to the upside, coming up from this low and then coming up to touch this top before it makes its way down. In either case, we do believe that the market stands to make a nice run to the downside if the dollar does not find good strength. But right now it's at a critical zone, especially since on the small intraday basis we're sitting up against daily resistance. Thank you so much for joining us for our weekly market update, and we look forward to touching base with you again next week.